Welcome to this explainer. Okay, so if you glance at your portfolio during that brutal semiconductor sell-off last week, you probably felt the panic. I mean, we all did. But right beneath that chaos, a massive relief rally was actually brewing, driven entirely by patient capital. So let's just dive right into the data and unpack exactly how that played out.
I want to kick things off with this classic Warren Buffett-inspired quote from our sources. The market is a device for transferring money from the impatient to the patient. It perfectly captures the theme of the week. It's a great reminder that panic selling right at the bottom of that semiconductor crash was absolutely the wrong move. If you held your ground while everyone else is freaking out, well, the mechanics we're about to cover will show you exactly why you were rewarded.
All right, here is our roadmap for today. We're moving from top-down macro forces straight into micro asset movements. We'll cover the split-screen inflation picture, Kevin Warsh's first FOMC test, forced buying in the NASDAQ 100, the crypto institutional plumbing upgrade, and finally, catalysts for the week ahead. Let's get into it.
The split-screen inflation picture, focusing on headline versus core.
7,431.46. That is where the S&P 500 closed out on Friday. The market didn't just survive that semi-sell-off, it completely absorbed it. And at the exact same time, the VIX, Wall Street's fear gauge, plummeted a massive 9% in a single day. So what actually triggered this giant market exhale?
Well, the answer really lies in this split-screen effect we saw with the inflation data. On one hand, we got a pretty scary 4.2% headline inflation number, which was driven almost entirely by an Iran war energy supply shock. Retail investors understandably panicked. But on the flip side, institutions confidently traded the much cooler 2.9% core inflation rate. Because core strips out those volatile geopolitical energy spikes, it's the actual metric the Fed watches. The second core came in below consensus, the rate hike narrative totally deflated, and bam, the relief rally ignited.
Section 2. Warsh's first FOMC test and the upcoming rate decision.
And that brings us to Kevin Warsh, who is chairing his very first FOMC meeting as the 17th Federal Reserve Chair. The tension here is just immense. As our sources point out, Donald Trump has publicly stated there is no reason to raise interest rates, applying some very direct political pressure. Meanwhile, the underlying data still paints a really complex inflation picture. So Warsh is caught between a rock and a hard place right now. Does he assert Fed independence and sound hawkish against sticky inflation? Or does he lean politician and bend to the pressure?
Now, honestly, you can forget the rate decision itself. The market has already priced in a 99.4% probability of a hold at 3.50 to 3.75%. The true volatility, that lives in a 30-minute window. We get the updated dot plot at 2 p.m. Eastern, projecting future rates, followed by Warsh's tone at the 2:30 p.m. press conference. That half hour is literally going to dictate the entire summer for us.
Moving on to Section 3, forced buying, specifically the NASDAQ 100 rebalance with CRWV and Nebius.
To really grasp why this is so huge, we have to understand the mechanics of forced buying. When NASDAQ announces a stock is being added to the NASDAQ 100, they set an effective date, in this case June 22nd. This means massive ETFs, like the QQQ, are contractually obligated to buy these stocks, regardless of how they feel about the market sentiment. It creates this massive structural wave of demand layered right on top of fundamental value.
And honestly, this is just a masterclass in timing. CRWV perfectly hit its technical entry zone of $91 just as the broader market was panicking. If you were patient, the NASDAQ inclusion catalyst basically stepped in and did all the heavy lifting, launching it near $96 to close out the week. It's a perfect example of how fundamental research can identify an entry point right before institutional validation arrives.
Then there is the absolutely staggering contracted backlog for Nebius Group, which is the other major addition to the NASDAQ 100. They're sitting on $46 billion in signed contracts. We're talking $27 billion with Meta, $17 billion with Microsoft, and a $2 billion direct investment from NVIDIA. I mean, this absolutely validates the intense institutional demand for their compute power. No doubt about it.
And the growth rate? Insane. Nebius reported 684% year-over-year revenue growth in Q1 2026. 684%. That number right there cements them as a dominant European AI neocloud. Toss in that forced index buying we just talked about, and they are quickly transitioning from a niche player to a foundational pillar of AI infrastructure for the next generation.
All right, Section 4, crypto institutional plumbing upgrade, looking beyond just the price. So, the big headline here is that Bitcoin snapped a 4-week losing streak and recovered back above $63,000. But here is the fascinating part. While retail investors are out there sweating over the daily red candles, institutions like Standard Chartered are definitively declaring that the cycle low is already in. It's the ultimate divergence, retail fear on one hand and quiet institutional accumulation on the other.
Seriously, just think about the strategic moves happening behind the scenes right now. Exodus and Ondo are transforming basic wallets into multi-asset brokerages. Citi is actually tokenizing private company shares. Visa and OpenAI are teaming up to build secure payment rails for AI agents. Oh, and CME Group? They're launching broad crypto index futures. Guys, this isn't just hype anymore, this is traditional finance permanently laying down the real-world infrastructure for a digital future.
A massive driver behind all of this is tokenization. And what this means for us is that Wall Street is taking traditionally gate-kept assets, things like private equity, and finally moving them on-chain. It is permanently blurring the line between traditional finance and crypto, massively increasing liquidity, and really just completely transforming how capital flows.
And finally, Section 5, Catalyst for the week ahead, setting up the summer.
Here is the exact timeline of events you're going to want to watch. Monday brings the manufacturing index, and Tuesday gives us retail sales. Both of these are crucial temperature checks for the consumer and the broader economy. And it all builds up to Wednesday's massive FOMC climax with Chairman Warsh. Finally, Thursday's housing starts will tell us if this current rate environment is already stalling out the housing market.
Another major catalyst to keep on your radar is the rapid drop in oil prices. As we saw progress on an Iran peace deal, oil dropped right down to the 84 to 87 range. This geopolitical de-escalation is a huge portfolio trigger. Because think about it, if a peace deal is signed and oil stabilizes at a lower level, taking profits or trimming those energy sector ETFs like XLE becomes a highly strategic move.
Which leaves us with this final, really critical question. Is your portfolio ready for Warsh? We've seen the data, we know the forced buying mechanisms, and we can clearly see the institutional positioning. But Wednesday at 2:30 p.m. Eastern, that is the inflection point. How he balances cooling core inflation against intense political pressure is literally going to dictate market momentum for the rest of the year. Thank you so much for joining me on this explainer. Stay patient, stay focused, and I'll catch you next time.